Welcome to this deep dive where we shortcut your path to being well-informed. Today, we're cracking open the Q2 fiscal year 2026 earnings call for Ocean Power Technologies. That's ticker OPTT.
Yep, and this one was a wild ride. The call was held on December 15th, 2025.
And really, this company is sitting at a fascinating intersection. We're talking maritime autonomy, persistent surveillance. It's a huge growth area.
It is, but the financials they just dropped were maybe the biggest credibility test the company has faced, a real test of faith for investors.
A test of faith is a good way to put it.
Well, what we saw was this colossal divergence. On one hand, you have management talking about explosive demand, a huge pipeline, and a great long-term strategy.
Now, on the other hand,
the income statement looked like a full-scale operational collapse. So our mission today is to unpack that tension, figure out why the market reacted so violently, and see what you should be watching.
okay, let's start with that snapshot of the results because the headlines were just brutal.
They were?
I mean, let's forget the EPS miss for a second. It happened, sure. GAAP EPS was negative 6 cents, missing the consensus of negative 2 cents. But that wasn't the number that really broke things.
No, not at all. The real headache, the number that sent people scrambling, was the revenue. Just a total collapse. They reported only, $424,000?
So $0.424 million.
Right. And to give you some context, that is an 82.5% drop from the same period last year when they brought in over $2.4 million.
An 82.5% drop.
Yeah. I mean, whatever the reason, a drop like that immediately forces a painful reassessment of, their execution risk, their reliability.
But this is where it gets so weird because that horrible revenue print just clashed violently with all the demand signals they were giving.
Exactly. It's a total paradox. Juxtaposed against that P&L nightmare, the demand side showed growth that you just rarely see. They said their backlog.
And just to be clear, backlog is confirmed, signed purchase orders, money they are owed.
Correct. That backlog surged by nearly 300% year over year. It hit $15 million. That's a huge confirmation of long-term demand.
300%.
And if you zoom out even further, their qualified pipeline, which they say is opportunities with customers under NDA, that grew 63% to a massive $137.5 million.
So the chain is breaking somewhere.
That's it. Think of it like a chain. The pipeline is potential, the backlog is contracts won, and the revenue is cash collected. They're clearly converting pipeline to backlog, but the machine just broke down trying to get from backlog to actual revenue this quarter.
So the big question, how did the market weigh this massive contradiction? I mean, the stock ultimately told the tale, didn't it?
It did. At first you saw some pre-market volatility, people trying to figure it out, but by the end of the day, the message was clear. Execution risk won the argument.
And the stock just plummeted.
It dropped sharply, closing down about 28% from its prior close. But here's the critical part. That sell-off happened on an 8-time spike in trading volume.
8 times.
Yeah. 21.2 million shares traded versus an average of about 2.6 million. A volume spike like that isn't just selling. It signals a liquidation event. Conviction fractured, and some big holders were likely forced out. The immediate pain just outweighed the future promise.
That kind of volume, yeah, that signals a true reset in how investors see this company. So let's dive deeper into the financial pressure that caused all this chaos, starting with the unit economics. The gross margin story was just brutal.
Oh, it's a shocking result. They swung from a gross profit of about $800,000 last year to a gross margin loss of negative $1.38 million this quarter.
A loss on gross margin.
A loss, yeah. Management's reason was the full recognition of, quote, one-time losses on some strategic startup contracts. GAAP rules made them book it all at once.
So they're saying it's a one-off.
They're saying the project costs are now substantially complete, but when you have to recognize a loss of that size, it puts immense pressure on a small company's liquidity. Investors need proof that these really were one-time losses and not, a sign of structural problems with their pricing or delivery.
That's the key. If it's not one time, they have a business model problem. Now, speaking of strain, let's talk spending. Operating expenses, OPEX, didn't hold steady. They jumped to $8.7 million.
Up from about $4.7 million last year, yeah.
So why the big increase right when revenue fell off a cliff?
Well, it was intentional, even if it looked painful. It was mainly two things. First, higher non-cash stock-based compensation. That dilutes shareholders but helps keep staff.
Okay. And second,
and this is more important, targeted headcount investments. They're hiring people for their commercial operations and delivery teams right now so they can actually handle that $15 million backlog and try to convert that huge pipeline.
But they have to manage the cash burn while they wait. That's the ultimate balancing act. What does their cash runway even look like?
This is the most important question. The company has $11.7 million in liquidity, cash, equivalents, short-term investments.
Okay, 11.7.
But okay, they used a staggering $13.1 million in operating cash over the last 6 months.
Wait, hold on. They burn more in the last 6 months than they currently have in the bank.
Exactly. At this burn rate, their current cash balance gives them slightly less than 6 months of runway if they don't start converting that backlog immediately. They are truly betting the farm on Q3 and Q4.
Wow. That kind of risk requires a bulletproof explanation for the revenue miss. So what was management's defense for that abysmal number?
They put it almost entirely on the lumpy nature of dealing with one massive customer, the U.S. federal government.
The government shutdown excuse.
The classic. They cited the shutdown timing as the main driver, said it pushed work into later quarters, and that they expect to recognize it later this fiscal year.
But come on, that's the default defense in this whole sector. Why should anyone believe it this time when the drop was so catastrophic?
It's a fair question. They tried to offer some operational proof. First, they pointed to the work that did happen. They shipped 8 WAM-V vehicles during the quarter for demos and trials, even if they couldn't book the revenue.
Okay, so things were still moving.
And second, they said they're actively pre-building their buoy assets now in anticipation of those big orders. So they're taking on the cost now, hoping to just flip the switch and recognize revenue the moment the contracts are signed.
So they're asking for trust. Did they give any hard numbers for next quarter to back that up? Any guidance?
No. No formal numeric revenue or EPS guidance was provided. They're really trying to force investors to focus on the pipeline and backlog conversion as the key indicators. Trust the demand story, not the quarterly volatility.
Okay, let's shift gears a bit and look at those strategic moves. The market punished the P&L, but the company's clearly trying to position itself as more than just a hardware vendor. What's driving that massive $137.5 million pipeline?
So the crucial insight here is that the way customers are buying is fundamentally changing. The government especially, they're not just asking for a single buoy or a single vehicle anymore.
They want a full solution.
Exactly. They're demanding complete intelligence, surveillance, and reconnaissance ISR services. Things that solve a specific mission, like border patrol or mine countermeasures. So even though the pipeline is split between buoys and vehicles, the underlying need is for an integrated service.
That's a big move up the value chain from selling equipment to selling a mission capability. What partnerships are they building to even support that?
They detailed a few key ones. And what's fascinating is the push toward full autonomy and digital simulation. They announced an integration with Mythos AI for advanced autonomy. Demos for that are planned for Q1 2026.
So making the vehicles smarter.
Smarter and more independent. And they also partnered with a company called Gradient Marine for digital twin and simulation capabilities. That's essential for military applications, letting customers model missions before they even deploy the hardware.
And didn't they also open up a totally new non-hardware revenue stream?
They did, and this is a really smart move. They achieved AUVSI, Trusted UMS Operator Training Provider status.
AUVSI, that's the big industry body for unmanned systems, right?
It is. So getting that status is a huge third-party validation. More importantly, it lets them monetize their expertise by training operators. It opens up a new high-margin service revenue channel that could help stabilize things against the lumpy government contracts.
Right. A comprehensive strategy like that, partnerships, services, training, it requires specialized people to pull it off, especially when you're selling to the military.
It does, and that's directly tied to their OPEX increase. They specifically said they're hiring veterans for their commercial and delivery teams.
Right.
Which is smart. It goes beyond just optics.
How so?
Well, a veteran understands the procurement process, not just as a business deal, but as a mission requirement. They know how to pitch the DoD, what capabilities are actually needed. They're staffing up to navigate complex channels, like the Coast Guard's Raptor Initiative and the Navy's Rapid Capabilities Office.
The Raptor Initiative, you've mentioned that a couple of times. Why is that one so important for OPTT?
The Raptor Initiative is the Coast Guard's next-gen program for maritime awareness. It's a big, multi-year framework for bringing unmanned systems into their regular operations. If OPTT lands a major role in that, it immediately validates their tech, turns a big chunk of that pipeline into multi-year backlog, and makes them a critical supplier in the homeland security space.
It's a potential company maker.
It is. That's why those hires are so targeted.
So what about looking outside the U.S. to maybe smooth out that volatility from the government cycle?
They highlighted demos and engagement in Latin America and the UAE, both for defense and for commercial oil and gas. And now they're seeing interest around the Baltic Sea. The international oil and gas sector is very interested because these systems can materially lower their costs for things like seabed mapping or pipeline monitoring.
So it all comes back to this central tension, this race against the clock.
Absolutely. This quarter was a huge failure on near-term delivery, but a huge success on signaling future demand. The market gave them a failing grade on execution, but the clock is ticking. Can that 300% backlog and massive pipeline convert fast enough to justify the cash burn? It all comes down to Q3 and Q4.
Which brings us to our high-risk, high-reward segment. And we have to say, this is not financial advice. We are simply analyzing the potential dynamics here based on the data from the call.
Extremely important disclaimer. We are talking about a highly volatile microcap stock and leveraged instruments. The risks are extreme. You could easily lose your entire investment.
Agreed. So given the 28% drop and that 8 times volume spike, this stock is in a pure asymmetric bet scenario right now. It's hovering around 30 cents, but a few big contracts could, easily re-rate it to over $1.
The thesis is simple. The stock price is completely detached from stable earnings. Its entire trajectory depends on landing a few big chunky contracts from that defense pipeline, probably tied to something like the Coast Guard's Raptor program. This isn't about gradual stability. It's a binary bet on a catalyst.
So the pitch for the outrageous but plausible trade is a leveraged bet on that catalyst, buying deeply out-of-the-money call options.
Yes. Specifically, we're talking about OTM calls expiring, say, 6 to 9 months out. Now, the implied volatility is high, so the contracts are expensive, relatively speaking. But the low share price makes the absolute cost potentially manageable.
So you're basically accepting the time decay risk.
You are, because you're making a pure play that management announces a massive pipeline to backlog conversion, a huge defense award, within that 6 to 9 month window, right when they expect the delayed Q2 work and the Raptor decisions to finally happen. If that catalyst hits, the upside could be exponential.
A high leverage speculation targeting that one critical moment of execution.
Precisely.
So, to summarize this deep dive, OPTT is a story defined by its immense divergence. You have this powerful, bullish narrative on future demand, that 300% backlog growth, the strategic move into ISR services.
But that narrative is struggling mightily against the brutal reality of their quarterly execution. An 82.5% revenue drop, a gross loss, and a really scary cash burn, all made worse by the government's contracting timelines.
And the company is making all the right strategic moves on paper, hiring veterans, building service revenues with AUVSI, partnering for autonomy.
But the market has put them squarely on the clock. The entire story hinges on what happens in the next 2 quarters.
So the final question for you, the listener, isn't just about execution. It's about external timing. Which macro catalyst hits first? Do rising global tensions force the Navy or Coast Guard to accelerate demand, giving OPTT the massive contracts they need to validate all this spending? Or does the high interest rate environment dry up their ability to raise cash, forcing a painful equity offering before that backlog converts? That's the tension that defines their fate. Thank you for joining us for this deep dive. We'll catch you next time.